Welcome back, family, to episode 2 of our Institutional Order Flow Masterclass here on Liquidity Hunter. If you watched episode 1, you saw exactly how smart money hunts sell-side liquidity beneath support levels to trap retail sellers. Before we jump into episode 2 of our Institutional Order Flow Masterclass, take 2 seconds right now to hit that like button and subscribe to the channel. Done it? Perfect. Now, let's get straight into episode 2. Today, we are flipping the market upside down. We are going to expose the exact engineering behind resistance traps, how the algorithms build massive pools of buy-side liquidity, and how you can spot a highly profitable market structure shift on gold. Let's look at this 4-hour chart on gold. Notice this specific area, highlighted inside the neon blue circle. To an untrained retail trader, this looks like a perfect textbook-style resistance zone. The price comes up, hits a ceiling, and drops. It comes up a second time, hits the exact same ceiling, and drops again. Retail books teach you that the more times a resistance level is tested, the stronger it becomes. So what do retail traders do? They aggressively open short positions right here, and they place their buy-stop orders, which act as their stop losses just a few pips, right above these previous highs. But I want you to step back and think like an institutional market maker. The big banks cannot just enter a multi-million-dollar sell order whenever they want. They need thousands of buy orders from the public to match their liquidity. This clean resistance line is not a barrier, it is an engineered trap. It is a massive pool of buy-side liquidity waiting to be harvested by the algorithm. Now, look at the next phase of this market cycle in image 2. Watch this sudden, aggressive upward expansion. The market makers drive the price straight through that blue resistance line, completely validating the red arrow labeled Liquidity Sweep buy stop run. When this happens, two massive psychological traps occur at the exact same moment. First, all the retail short sellers who thought this resistance would hold are instantly stopped out, because their stop losses were buy stops. Their stopped out trades instantly turn into forced market buy orders. Second, aggressive breakout traders see this massive green candle breaching the high and they think gold is breaking out. It's going to the moon. So they jump in and buy the breakout. Look closely at who is buying here. Stopped out sellers are buying, and FOMO breakout traders are buying. This creates a massive flood of buy orders. And who do you think is selling to them? The institutions. The smart money uses this heavy inflexive buying pressure to fill their massive sell blocks at the absolute highest possible price. This is a classic liquidity sweep. Once the liquidity is cleanly swept, the trap is sprung. Look at image 3. The price completely fails to sustain itself above the high. Instead of closing above the resistance, it reverses violently to the downside with massive institutional displacement. As the price crashes downward, it does something critical. It aggressively punches straight through the most recent swing low, highlighted right here inside the white glowing circle. This is the exact moment a market structure shift, or MSS, is confirmed. The MSS is your ultimate saving grace as a technical trader. It is your definitive mathematical proof that the previous upward breakout was a complete lie, a pure liquidity raid. The fact that the institutions were able to shift the market structure below this key swing low tells us that the order flow has officially turned heavily bearish, and the big players are now fully committed to driving the price lower. Now that we have structural confirmation, how do we actually execute this trade without chasing the price? Look at image 4. That aggressive, violent downward move left behind a massive imbalance in price delivery. This imbalance is our bearish fair value gap, cleanly outlined by this vertical red rectangular box. As retail traders, when they see a big red candle, they panic and press the sell button at the very bottom due to FOMO. But as smart money hunters, we exercise extreme discipline. We never chase price. We know that the algorithm is legally designed to pull the market back up to mitigate and fill this inefficient premium gap before continuing the markdown. Now, look at the final masterpiece in Image 5. Watch how beautifully the market retraces exactly back upward, tapping directly into our red FVG box. The exact fraction of a second that price touches this imbalance, we trigger our confirmed SMC short entry right inside this neon green target crosshair. Our risk is completely protected because our stop loss is safely placed just above the institutional swing high, while our take profit target is locked onto the internal sell-side liquidity pools resting at the very bottom of the screen. This gives us a massive risk-to-reward ratio trade. Stop buying the breakouts, stop being the liquidity, and start hunting it. If you want to master internal versus external range liquidity, hit that subscribe button right now and stay tuned for episode 3.